Hello there, Dana here with your Thursday options trading video. Today I thought we would review some basics because, of course, our foundational knowledge of options trading is imperative to us becoming consistently profitable traders. So let's look at some basic concepts. Options trading begins with the underlying security, generally speaking. A security in this context simply means a stock or an ETF or exchange traded fund that is publicly traded on the stock market exchange. Many retirement plans like 401ks or IRAs are made up of some of the holdings of stocks and or ETFs among other assets. Some examples of stocks are shown on your screen. You've got Ford, Apple, Bank of America. I have them abbreviated with their stock tickers. Also, ETFs, they include XLU, which is a basket of utility stocks and holdings, and SPY, a basket of the top holdings in the S&P 500 index. You've seen me do quite a few trade recaps on SPY. Using technical analysis or fundamental analysis or a combination of the two, an options trader may speculate as to the price direction of the underlying stock. For example, this means is there some evidence that may support that the price of Ford, Apple, Bank of America, SPY, XOU, or any other underlying asset may increase or decrease in a specific period of time. Based upon that options trader analysis, she may then choose an option contract in relation to the price direction she identified. So she may choose a call contract if you're looking in the middle of your screen, a call contract if she believes the price of her underlying stock may increase. She may choose to purchase a put contract if she believes the price of the underlying stock or asset will decrease. Remember, the options contract is directly correlated to the underlying stock or ETF. The option itself is a derivative of the security. Simply put, the option contract cannot exist without the security. So your options contract will be controlled by the price movement of that underlying security. When the investor chooses her options contract, whether it is a call or a put, her research should determine what strike she should choose, as well as the premium or how much she will pay. Some other factors that she may consider include open interest, volume, and the Greeks, including delta. Delta suggests the impact on your contract with every dollar price increase or decrease in the underlying stock, as well as theta, another options Greek, which suggests how much the value of your options contract may decrease with each passing day or with the passage of time. The strike, the Greeks, and expiration date are factors that may impact the premium, also known as the cost of your investment. Think about it. If you are purchasing a strike that is way out of the money, not even close to the current price of your current underlying stock or ETF, and your expiration date is today, that premium is probably going to be pretty cheap, pretty inexpensive. Why do you think that is? The probability of a profit on that contract is going to be super low. So I say that to say just because the price looks good doesn't mean that that's the contract that you should purchase. But going forward, so we've talked about some things you would consider in purchasing your options contract. So how do you get out of it? Finally, the whole goal with options trading from the perspective of my trading style is to sell at a profit. That means that if the price of the underlying stock or ETF has moved consistent with my speculation as to price direction and the timing of the price direction, then I'm likely going to be at profit. But it also happens you may sell at a loss. This means maybe your stop loss has been violated or you're getting closer to the expiration date and the price of your underlying simply is not moving in the direction of your speculation, particularly at the timing that you had speculated. Or that options contract could expire worthless. That basically means that the expiration date has arrived and the options trader was unable to sell her contract. Basically, nobody wants it, and therefore she has lost all of her premium or financial investment. Another thing to consider is assignment. Assignment may be triggered when the buyer of an options contract exercises their right to buy or sell the underlying security at the strike price. It's important for you to review your trading platform's rules on assignment, particularly if you are using options trading as a strategy to acquire stock and if you want to avoid the risk of assignment of a stock you simply don't want. The takeaways here is I hope you are taking advantage of all of the education that your trading platform provides, whether it's a webinar, an article, any type of training. Watch it, listen to it, learn from it, because this will put us on the path of being a consistently profitable trader. We've got to understand the basics. So until the next time, I hope this has been helpful to you. Take good care. Goodbye.